guess one problem for alternatives, or maybe selling it to investors, is that you're not going to get those outsized returns. So I'm trying to imagine somebody gets into an alternative, they see the stock market up 20%, so they shift out of that without thinking of that long-term balance.
I think that's the benefit of financial advice and education, media outlets such as this, et cetera, to help investors understand that not all asset classes have the same potential return over time, but you want a mix of as many as you can get and low correlations to one another to even out the ride so you can stay the course. There are outsized returns at times. You saw some alternative products have significant positive returns in 2008, while equities were down 35%, on average. So, but over time, you should not expect equity-like returns from alternatives.
One interesting product that you just launched was a frontier market debt fund. That's probably something nobody would have thought about even just a couple of years ago. Tell me a little bit about why that product made sense.
Yeah, so I talked earlier about efficiencies in the marketplace and high correlations among asset classes, particularly during times of stress, et cetera. So part of the the game or the goal is to find asset classes that don't correlate highly to one another. And if we look at frontier markets, they're really where emerging markets were 10 and 20 years ago. What we liked about this particular product is no one else had done it in a mutual fund space in the U.S., yet we had a team that we were familiar with, had been in discussions with 2 years over in Denmark, and had run this type of product for a long time. What's interesting about frontier debt is it doesn't correlate highly to any other type of debt or any other asset class.